An offer in compromise is a deal to settle for less. It's something set up by Congress to allow taxpayers who are indefinitely over their heads settle for less and get on with their lives. And the premise behind an offer in compromise is to give you a fresh start, get you back into the tax system so that you're a productive tax-paying member of society instead of doing what it's very likely that you have been doing, which is putting off the pain of dealing with your IRS problem, and it's just getting worse and worse every year. My name's Darrin Mish, and I'm an attorney, and I run a law firm out of Tampa, Florida, and we represent taxpayers nationally and internationally with their problems with the IRS. That's all we do there, and so we've gotten very good at it over the years. You're probably familiar with the website, getirshelp.com. In fact, you might be watching this video on getirshelp.com, and I welcome you to visit. If you haven't visited, come on by and take a look. There's a lot of free information on the site, a tremendous amount of information that can be very helpful to you. Now, an offer in compromise is not a deal or a giveaway. It's a program designed to determine exactly how much you can afford to pay, no more or no less. And you'll see in a minute when I get into the technical details of exactly how an offer is calculated, and you'll understand what I'm talking about. But the idea of an offer is for the IRS to determine exactly how much you can afford to pay, no more, no less. So if you owe $100,000 and you have equity in your home of $200,000, then it's not very likely that you're going to get an offer in compromise, and that makes sense, doesn't it? If I was your creditor, if I owed you $100,000, and you were determining whether or not or how aggressively you were going to come after me in terms of collecting that money, you'd want to take a look at all my assets, so my home and all my other assets, and you also want to take a look at my ability to earn, my monthly disposable income, what I have on a monthly basis to pay you, and that's exactly what the offer in compromise program does as well. Now, the formula is really easy to understand once I explain it to you, but let me go ahead and break it down. The first step that you have to look at is we need to come to a figure called your monthly disposable income. And the monthly disposable income is actually the difference between your monthly income, so your gross income from your job or your small business or whatever, and then the IRS is going to go ahead and subtract out what are known as your monthly, quote, allowable expenses. And you heard me go ahead and make some emphasis there on the word allowable. It's the IRS's opinion of what's allowable, not really what you think is necessary. Okay? So technically, the IRS talks about allowable expenses as reasonable and necessary expenses, and there's some loopholes and there's some standards and things like that, but basically allowable expenses are expenses that are broken down into formulas, into worksheets that we have access to and we can help you with. But I don't want you to be under the misimpression that your allowable expenses are liberal or generous, because in fact they're very draconian, they're very conservative, and they're not very realistic in my opinion. And in fact, many IRS employees will tell you the same. So the second step is to find out how to calculate your offer. And this slide actually doesn't do it justice. The way you calculate your offer is you take your monthly disposable, for a cash offer anyway, that's what we're going to talk about here for a second. A cash offer is determined by taking your monthly disposable income, multiplying it by 48, adding in your assets, and that equals your offer amount. So if you want me to go ahead and put some numbers to that, this is how that works. If you had $50 in monthly disposable income and you multiply that by 48 plus your assets, let's assume your assets were zero, that would mean that your offer amount would be $2,400. Now, it doesn't matter how much you owe at all. It matters what you can afford to pay. So in that illustration, and by no means is that your situation, it's just something being offered up so you understand what the formula is, then you would be able to offer $2,400, and the IRS, in theory, if everything checked out, they should accept that. Now, that's a cash offer. A cash offer is payable within 5 months. So it takes I don't know, something like 6 months for them to investigate an offer minimally anyway, and then after they say yes to that $2,400 in that scenario, then you would have another 5 months to go ahead and pay that off. You can pay it off in one lump sum, or you can pay it off in 5 monthly equal installments. It doesn't really matter, but it's got to be paid in full within 5 months. Now, there's also a catch to an offer in compromise, and that is you have to stay current for 5 years after the offer is accepted and paid. Now, what does that mean to stay current? That means you need to file your returns on time every year, and you need to pay on time every year. So if you continue to do whatever it was that got you in this mess to begin with, immediately after an accepted offer, then it's going to come back. It's going to be accelerated with all the tax penalties and interest, and come back, and it's going to haunt you big time the next time. So you're going to want to go ahead and stay on the straight and narrow for that 5 years. You're kind of on probation during that time frame, but if you get a good enough deal, it's certainly worth that risk. Now, it's interesting to note that there's nothing magic about an offer on compromise. It's all numbers. It all fits into that formula that I gave you for the cash offer. Now, there's a couple other types of offer as well in terms of how to calculate and how long the payout is. One of those is called a short-term deferred offer, and that's payable out over 24 months instead of 5 months, as in the cash offer scenario. The 24-month period, you need to make equal monthly installment payments. So, and the multiplier changes quite a bit. So, if your monthly disposable income was $50, as in our first example, then you're going to take that $50 and you multiply it by 60 this time, plus your assets, and we'll